Good afternoon, everybody, and thank you so much for joining our webinar today, CDHP 101, Behind the Wheel of Consumer-Driven Health Plans. My name is Amanda, and I'll be your moderator today. Our ERISA attorney, Larry Grugin, is our presenter. This webinar is full of a whole lot of information, so if you miss anything, don't worry. We'll be emailing you a recording and the slides after the webinar concludes. As always, we'll be keeping the webinar muted to avoid any background noise. But we'll stop at the end for questions. Just type your question in the box below and I'll read it aloud for you for Larry to answer. Our next webinar will be on January 16th, our first webinar of the new year, and we'll be covering wellness plan compliance. It'll also be at 1 p.m. Central. For now, I'm going to turn the presentation over to Larry.
Well, thank you very much. What this seminar is trying to do is explain those devices that are important when you have a consumer-driven healthcare or more high-deductible plans. Some of these plans are more traditional. We're talking about cafeteria plans. Others have been around for 10 or 15 years, HRAs. And then I'll be introducing the area of HSAs. Now, because of the time restraints, I can't cover every aspect of each plan, but I'll give you a good introduction because some of these plans are very complicated, and I'll be talking about those areas that I think are important for you to know when you're offering a plan. So first of all, let's look at cafeteria plans. Cafeteria plans have been around since the late 70s. And cafeteria plans are a written plan for employees who may choose between cash or qualified benefits. So basically, what's important here is the cash is considered to be unreimbursed or unreduced cash and benefits. So basically what you have here is you have a cash requirement, and that can be satisfied in a number of ways. You can basically allow people to waive out of benefits, not to participate, or contribute on an after-tax basis. There's a salary reduction aspect of it. Over the last 15 to 20 years, more and more employers are asking employees to pay part of the premium. To soften the blow in this, that's why the salary reduction pre-tax contributions are extremely important, because these contributions are not subject to income tax, Social Security, or Medicare. And of course, you have an election. So there has to be an election part of this where the employee chooses whether to participate or not, what benefits they want. And a cafeteria plan can be very complicated, very simple. Most employers have what's called a premium only or POP plan. And there's a whole array of benefits that the employer makes available to the employee. They choose which one they want to contribute to. And sometimes it's fully contributed by the employee, some of it or all of it. And then you have health flexible spending accounts, which basically allow an employee to pay for those expenses not paid for by the insured or self-insured group health plan. The health FSAs will do that. They will fund deductibles, copays, and coinsurance. And lastly, there's dependent care programs where basically if somebody has to work and they have to have a babysitter or someone watch them, they can pay for part of the cost of that. Now, as part of the healthcare bill, I haven't seen the final, that may be affected on a new tax reform bill. So stay tuned for that over the next few weeks to see how that's affected. And you can have a cafeteria plan with all or some of these different types of plans in them. So how a cafeteria plan work? An employee completes a election form for salary reduction. A designated portion of the employee's salary reduced every paycheck varies the proportion of premium or expenses. The employer collects the amounts, paid the premiums for the employee coverage. The employer reimburses employees medical and dependent care expenses if they have it, and that both the employer and the participants saves FICA and FUTA taxes on the contributions. So it's a win-win for all individuals when you have a cafeteria plan. Now, so what are the employee advantages? Well, there's tax savings on income tax and FUTA. Flexibility, the employer can offer more benefits, so the employer can custom make what benefits, if they don't have children, they may want to have life insurance as opposed to something else. So more benefit choices may be available. And the employee advantage, as part of the health FSA is there's what's called the uniform coverage rule. Well, basically it's treated just like insurance policy, where if somebody elects the full amount, $2,650 for 2018, that $2,650 has to be available on the first day of the plan year. So if you have expenses of $2,650 in January and you use it all up, and then you quit 2 days later, basically the employer has to fund that entire benefit. That's the uniform coverage rule, and that's where why some employers made an offer. They don't, especially if they have a lot of turnover, they don't want the expense and the liability of funding those benefits and people leaving and getting reimbursed for the whole amount when they haven't contributed that amount. And some employers tried to get some of that money back by requiring employees to pay part of it back. And again, the IRS has said time and time again, the employer can't do that. Employee disadvantages. Well, elections are irrevocable, except for change in status, change in roles. And that's something that I think employees have a hard time understanding. They say is that, well, it's my money. Why can't, if I don't want the benefit or I can't afford the benefit, how come I can't change my my election? And the answer is, well, I'm sorry, because it's pre-tax, you have to follow the requirements of the cafeteria plan rules, and only under certain conditions, and we'll be talking about that in a few minutes, can the employer allow the employee to change their election. So that's something to really explain to employees when you sign up for this. I'm sorry, unless you have a qualifying event, you can't change your election. And another aspect of this is you try to explain to employees the use it or lose it rule, where if money is available at the end of the year, now you can soften the blow to use it, lose it rule by having a carryover or a grace period, where you have a period of time where up to a certain amount can be carried over. So that's been softened over the past few years. But again, unless you, and that's not a requirement to have in the plan, you can say, I'm sorry, if you haven't used all the money about the end of the plan year, you lose it. That's something that employees are discouraged from participating. So employer advantages, tax savings and FIDA FUTA, state employment tax and workers' comp, improve recruitment and retention, because almost every employer has some type of cafeteria plan. Cost savings, providing flexible benefit structure, especially younger people like the high deductible plans, because they're not paying for coverage they don't use. Income on employee premium increases are softened if you pay for the premiums on a pre-tax basis. And again, as employees pay more for coverage, they have a greater awareness of the benefit costs. Because many employers think, well, my premium is what the coverage cost. It's only for many employers, it's only a small portion of the entire premium. Well, employer disadvantages, well, initial setup costs. There's ongoing administration. Many employers have an outside TPA administering the plan, and there's always issues and problems. Expense related to communication of benefit programs. Congress keeps on changing the rules on this, so every few years the documents have to be updated and changed. And again, especially if an employer has a lot of turnover, there's the uniform coverage rule, where the employer takes it on the chin if somebody leaves and they haven't contributed the full amount, but they took the full amount out. So that's part of the problem. So what are the legal requirements? Well, there has to be a written plan that is required. It has to be in writing. You can't just take money out of people's paychecks without actually having it in writing. There should be, you should describe what the eligibility requirements are to the employees. You should describe the benefits are included. There should be procedures for governing elections. Tell the employees under what situations they can change their elections, manner to which contributions are made. Generally, pre-tax contributions are there for prospective benefits. You can't go back. The only exception to that is for new employees. You can go back 30 days. There's manner of which contributions are made, maximum employer contributions, because you have to be careful in that, because there's special exception for flexible spending accounts to avoid ACA. And then everything has to revolve around a plan year. Many employers have calendar year plan years, but it doesn't have to be that's the case. Reporting and disclosure requirements. Well, in that situation, generally you should give employees a summary. Reporting in that situation, if you have a health flexible spending account, it's considered to be an ERISA plan. If you have under 100 participants, there's no 5,500. Only the health FSA is subject to ERISA. It's considered to be a health plan under ERISA. There are non-discrimination rules. There's eligibility to participate rules. There's contributions and benefits testing you have to do, and key employee concentration tests. So again, once you set up a cafeteria plan, there's a whole series of non-discrimination rules that have to be done at least once a year, and you have to demonstrate the fact that you passed all these. Now, generally, most employers don't have a problem with cafeteria plan rules because everybody is subject to the same benefits. But when you start having different eligibility rules and different contributions for different benefits for different employee groups, that's when these non-discrimination rules come in and you may have a problem. So again, many times if you're going to pay more for an executive versus the rank and file, you may want to keep those people out of the cafeteria plan to avoid any problems with these non-discrimination rules. So any employer can sponsor a cafeteria plan. There's no minimum size requirement, no required form of ownership. Only employees of the plan sponsor or control group can participate. You can't have unrelated employers. And a former employee may participate if active employees predominate. So if, for example, if you give retirees a certain amount of money, they can participate. Now, again, if you are self-employed or if you are a more than 2% shareholder in an S Corp, you cannot participate on a pre-tax basis. So that's the, so common law employees are generally the individuals that participate under these plans. So a qualified benefit basically is any benefit that does not defer compensation or excludable from gross income. Qualified benefits generally for premiums include health premium, health plan premiums, dental, vision, AD&D, disability, DCAPs, dependent care programs, health FSA, group term life insurance, paid vacations, 401k deferrals, adoption assistance, and retiree group term life insurance policy premiums can go through a cafeteria plan. But again, you can pick any or all of these benefits to put through a cafeteria plan. Now remember, in that situation, if you put voluntary benefits through a cafeteria plan, that's one of the aspects that the DOL and IRS look at to see whether it's subject to ERISA. So putting that, and also if you put disability premiums through a cafeteria plan, any benefits coming out will be taxable. So some employers actually leave those out of a cafeteria plan because if you have post-tax contributions on a disability program, the benefits coming out will not be taxable. So that's one thing to consider in regard to this. The following benefits are not qualified and that may be offered. So they're not considered. You can't put educational assistance, qualified scholarships, qualified tuition reductions, no additional costs, qualified employee discounts, working condition fringes, transportation fringe benefits. They got to be separate from a cafeteria plan. You can do pre-tax in regard to that. Qualified moving expenses, gyms, meals and lodgings, dependent group term life insurance, medical savings accounts, long-term care insurance, and benefits that defer any type of compensation cannot go through a cafeteria plan. So these benefits cannot be put through a cafeteria plan. Now, individual health insurance premiums, I would not advise doing it because the fact if you put it through, that may subject those individual health insurance policies to ERISA. Same thing with hospital indemnification and cancer policies. In that situation, what happens if an individual is reimbursed more than what the expense is, A certain portion of the amount that's being paid to the employee would be taxable, and the employee has to withhold. So you're going to be very careful in regard to that. Also, health insurance coverage for domestic partners. In that situation, you have to be very careful because the domestic partner has to qualify as a qualifying relative to participate. In some situations they do, in some situations they don't. But again, you have to be very careful in that regard when you start making domestic partners eligible, because if they don't qualify as a qualifying relative, then any benefits paid to them have to be taxable. So here you have different types of cafeteria plan contributions. You have employee contributions, can be either post or pre-tax, put through a cafeteria plan. You can have non-elective employer contributions. Many times people have matching contributions, or they may have what's called a flex credit, where the employer says to the employee, I'm going to give you $500 or $1,000 a month, and you decide what you want, and that's going to be a pre-tax contribution. Now, either in that situation, if the employee doesn't use all of it, sometimes the employer gives them cash. Other times it goes through either into a health FSA or an HSA. Now, you also have opt-out and cash-out provisions. In that situation, if you decide, if somebody waives coverage and medical coverage, you can provide them a cash benefit. If you're going to do that, that cash or opt-out benefit has to be through a cafeteria plan. Because if you don't put that opt-out benefit through a cafeteria plan, even those who pick benefits will be taxed on it. So again, that can be another benefit under a cafeteria plan. So again, here the employer agrees to reduce their salary on a pre-tax basis. Such contributions are considered to be employer contributions for tax purposes because they're not taxable. Employer gives up the right to the amount of salary reduced before being entitled to it. So anytime you make an election, there's only one exception to that. It has to be prospective. In other words, before the salary is earned. That's a general rule in regard to that. So this arrangement allows an employee to pay for coverage on a tax advantage basis. So non-elective employer contributions can be contingent, where they say, okay, if you participate, for example, in a health benefit, I will pay 80% of the premium. Or it can say to the employee, if you decide to participate in a health FSA, I will match those contributions. Or as I indicated before, you can have flex credits where the employer says, I'm going to give you $500 a month. You pick and choose what benefits you want, but that's how much, that's the total I'm going to contribute to your benefits, and you pick and choose exactly what you want. And again, there could be variations of each of these under a cafeteria plan, but you have to remember, if you start differentiating between employee groups and how much they're going to receive, that's when you could run into non-discrimination issues. When are elections made? Plan documents must contain procedures describing the election period, the period during which elections are made, during which the elections are effective. In general, elections may be made in advance before the beginning of the period of coverage. They are irrevocable and made on a prospective basis. Now, what many, if you look at many cafeteria plans, what they do, they say once you've elected once, and this is for the premium only contributions, next year, if you don't tell us otherwise, then those elections roll over to the next year. Most employers do not apply that evergreen or that rollover election to health FSAs or dependent care. They want you to elect every year. But for the premium only contributions, for the premium benefits, you can have a procedure that has to be cited in the cafeteria plan that indicates that you make it one election, and then next year you can always revoke it at open enrollment. But if you don't act, then that benefit election roll over. That's very popular with most employers. So open enrollment needs to occur before the first day of the plan year. There's enrollment periods for new hires and special mid-year elections, of course, if you have qualifying events. If you have a new spouse, a new child, that person could enter into the plan. There's a special enrollment right, you can do it. But it's very important because of that. In that situation, they have to elect within 30 days. If they don't elect within 30 days, then the employer can refuse the entrance for those individuals inside the plan. So again, there's special mid-year elections in regard to that. So if a mid-year election changes, generally elections are irrevocable, but there are 14 different events that are allowed under a cafeteria plan that are recognized in regard to changing elections. Other events may permit a mid-year elections. For example, if somebody comes to you a few months after making elections saying, I made a mistake. A very common mistake in this situation is somebody says, I elected dependent care and I don't have kids. It was just a mistake. And I tell people if they come in within a few months, allow them to revoke their election because it's obvious. So again, you basically have to indicate under what situations that person's election can change and when that election is effective. That's got to be stated both in your plan document and your summary plan description. So these are the events that, and again, as an employer, you can pick any or all these events. Change in status, getting married, having a child, cost changes for automatic increases and decreases. If you have a change, in your premiums during the plan year and it's not significant, you don't need a new election. If there's significant cost changes, you can put that in there. You can allow an individual to, in that situation, to change coverages or elect out. Significant cost curtailment. Somebody is an HMO and the area they live in, the HMO withdraws providers. They can allow them to change coverages. Addition or significant improvement of benefit options. If you have a change in your packages during the year, you can allow them to elect a new coverage. Change in coverage in another employer's plan. In that situation, you have a spouse, they have open enrollment in their employer, you can allow them to drop the plan and enter that employer's plan. Loss of coverage under a group health plan of government or educational institution, that person loses eligibility and therefore in that situation, you want to join your plan. HIPAA special enrollment events, that generally does not apply to health FSA. That's if you lose coverage, you gain a spouse, you have a new child, and also if you gain eligibility in Medicare, Medicaid, these are events you can allow them to change their election. Also, COBRA qualifying events, you can change your election. Judgments, decrees, in that situation you have to add a child because of a qualified child support order. Entitlement to Medicare, you can allow a person in that situation to drop coverage. Under family medical leave, you can allow them to drop coverage if they're under family medical leave. Enrollment in Medicare, Medicaid, or in the marketplace, excuse me, and reduction of hours. Reduction of hours applies to if you have a variable hour employee, they have elected coverage, they're doing pre-tax. Now remember, if you have a variable hour employee during the stability period, they're treated as being full-time for the entire year. There's a special exception. If that person has a reduction of hours, that individual can be allowed to drop coverage if they have a reduction of hours. In enrollment in the marketplace, in that situation, open enrollment just ended. Somebody says, well, you know, I determined it's much cheaper to go in the marketplace. I want to enroll in the marketplace this year, and I want to drop coverage. The employer in that situation can allow an employer to drop coverage. Again, the employer has a right to select any or all of these events. It's up to them. So let's look at flexible spending accounts. Flexible spending accounts are a program that provides coverage under which eligible healthcare, dependent care, and expenses are reimbursed. It's subject to maximums and reasonable conditions set by the Internal Revenue Service. Employees pay pre-tax reductions to their flexible spending account, and the employee receives expenses for reimbursement for certain eligible expenses. And again, you have both for the dependent care and the health FSA. you have a use it or lose it rule, which just discourages some employees from participating. So there's healthcare FSA, a dependent care FSA, and adoption FSA. I'm just going to concentrate on the first two because they're more prevalent and more popular. So the legal framework of a health FSA is considered a self-insured medical reimbursement plan. There are separate non-discrimination rules with that. It's considered a group health plan both under COBRA and HIPAA. It's considered a welfare benefit plan under ERISA, and it's subject to the non-discrimination rules under 105H. So we have non-discrimination rules for the general cafeteria plan, and there's separate non-discrimination rules for health FSAs. Now there's coverage for 12 months. During that coverage period, pre-tax contributions are taken from the employee's paycheck. And again, the participant submits claims for reimbursement. Those claims for reimbursements have to be substantiated. So that employee, what that means, that employee has to show receipts, the fact they've actually have incurred. Now, what's important here is that the employee doesn't have to pay for that expense. They have to incur the expense. So it's not required under the law that the employee actually pays the bill. They just have to submit the bill to you, show evidence they've incurred that expense in order to be reimbursed. So again, the election must be made prior to the effective date of coverage. Elections are generally irrevocable. The cafeteria plan med election changes generally apply, but again, only certain events apply to health FSAs. Plan documents can be more restrictive than the regulations. So you can pick and choose what that means in layman's language. You can pick and choose what expenses under the health FSA that you want to actually reimburse. So you can do all the medical expenses under 213D of the Internal Revenue Code, or just some. It's up to you what you want to do. Now here, mid-year election changes, I covered them a few minutes ago, and I said there was 14 different events. Out of those 14, only 5 apply to health FSAs. That's extremely important to remember. And those other 9, cover apply to the premium only. Only these 5 apply to health FSAs. Change in status, COBRA qualifying events, judgments, decrees, and orders, entitlement to Medicare and Medicaid, and family and leaves and absence. What that means is, and this is very popular, if you have a change in cost and coverage, that doesn't affect the election under the health FSA. If an employee comes to you and says, I'm sorry, I've elected to participate in the health FSA, I can no longer afford it, I want to change. As you can see in this situation, not affording the election is not one of the qualifying events under a cafeteria plan. So again, that's got to be stated in the cafeteria plan. Only 5 of these events actually apply to a health FSA. So again, the legal requirements for eligible expenses must be an eligible expense under the written accident and health plan, must be for health care, medical, dental, vision, must be incurred during the coverage period, must have incurred by the covered employee, spouse, or dependent children. And again, only those individuals can be allowed, those expenses can be allowed. And again, a domestic partner their expenses can only be reimbursed if they qualify, what's called a qualifying relative. May not include any expense of which the employee actually claims a income tax deduction, cannot be reimbursed by any other source. And remember, health FSAs cannot reimburse premiums. And one of the requirements, there has to be adequate claim substantiation, which means there has to be a receipt that shows when that expense was incurred and what the reason is, so the third-party administrator or the employer can determine whether it's under the plan terms. Examples of eligible expenses: office visits for the doctor to treat illness and injury, prescription drugs, over-the-counter drugs that cannot be reimbursed, hospital room and board, surgery, cover dental treatment, eye exams, eyeglasses, contact lenses, and there are many more. And there's a publication called 502 that lists many of the medical services and expenses. But what's important is that expense cannot be reimbursed or can be reimbursed any other place. Very important. Examples of that are not eligible: cosmetic treatments, illegal operations or treatments, qualified long-term care, and insurance premiums. Again, the employer can determine the limitations of what can and cannot be reimbursed. So an employer could put limitations, and what cuts down the administration of the plan if you say to the employee, you know, I will reimburse any expense that would normally be reimbursed under my medical program, and it's paid because it's not because you didn't meet the deductible, copay or coinsurance. I will reimburse. You can be reimbursed under the health FSA. So all you have to do is present to me an EOB showing it wasn't paid, and I will pay it. So that's an easy way of administering the health FSA, because it will show it wasn't reimbursed any other place. So use it or lose it rule. Unused salary reductions cannot be carried over to the next year. And again, the exception of that is that you can do a carryover or you can do what's called a grace period. An employee will lose salary reduction contributions if they're not submitted. The IRS will not impose any taxes on forfeited employee contributions. Plan document determines how the employer may use the forfeited contributions. Most plans allow a short runout period, and forfeitures for participants' health and dependent care may be retained by the employer, used to defray administrative expenses, used to reduce salary reduction contributions, or returned to the employees for reasonable and uniform basis. Most employers just use it for the administration of the plan. Most employers don't return the money of the forfeitures back to the employees. But again, there's two exceptions to the use it or lose it rule. And this is the carryover and grace period rule. In this situation, as an employer, it modifies the use it or lose it rule. An employer may amend the cafeteria plan document for a grace period, and that grace period can be up to 2.5 months after the end of the plan year. And what that means is any amounts remaining after the end of the plan year and for 2.5 months can be used during that 2.5 months, any amount. So if somebody has $700 left over, 2.5 months after, that money can be used to reimburse, to be used for expenses for the previous year or for the current year. A couple years ago, the IRS, that's called a grace period. They can do a carryover. Under the carryover rules, up to $500 can be carried over to the next plan year. And you can decide as an employer whether it's 500, 200, or whatever it is, and that's carried over and until it's used, and the employer can actually indicate how long that money can be carried over. The only problem with the grace period and also the carryover situation is that if individuals have money sitting in their cafeteria plan and their health FSA, then that person cannot be eligible to contribute to an HSA unless that money is carried over or under the grace period as a limited purpose, which I'll be discussing in a few minutes. So again, those provisions are optional. The employer doesn't have to include them in their cafeteria plan, but it's attractive, because one of the biggest stumbling blocks of a cafeteria plan is the fact that employees don't want to lose money. This extends the period of time that person can use the money and not actually lose it. So under the uniform coverage rule, anytime during the coverage period, the participant may be allowed to withdraw the full amount they've elected. So if they've elected in 2018 the full amount of $2,650, then they can be paid $2,650 if they present expenses on January 2nd. So That's what scares many employers, especially if they have high turnover. People come and go and they take all the money with them. So if a participant doesn't have a significant amount to cover the withdrawal, the employer must reimburse those amounts. They can't require the employee to pay back that money. So again, claim substantiation, health FSA claims must be substantiated. There must be a written statement from an independent third party, which is the provider, and a written statement from the participant providing for medical expense that has not been reimbursed. Under this third party statement, the requirement, it verifies the expense was incurred and ensures that advanced reimbursements of future and prospective expenses are not paid. So it shows that the expense was actually incurred. So originals, copies, fax, or scanned copies, originals should satisfy that requirement. But credit card receipts and canceled checks, if it doesn't show what the expense is not enough. And the participant statement must provide the expense has not been reimbursed. The employer will not seek reimbursement from any other source, and the expense was incurred. So for 2018, now it's going to be $2,650 that can be reimbursed, and that's only applies to salary reduction contributions. It does not apply to employer contributions. And again, it applies on a plan year basis. If you have a short plan year, those limits are reduced. So the maximum contribution should be carefully observed. And again, if you want a smaller amount, you can actually specify a shorter amount in that. Okay, let's briefly go through dependent care plans. They're not as popular as health FSAs. So it's a salary reduction plan under 129 of the Internal Revenue Code, not covered. It's not considered an ERISA welfare plan. It's considered a flexible spending account under 129 and needs to comply with the 125 rules. The plan terms must be in writing and must be an exclusive benefit of the employees, the purpose for which to provide employees with dependent care assistance. Reimbursement must be for employment-related expenses. It doesn't need to be funded. And again, there are specific non-discrimination rules that apply to this. It's subject to the use-it-lose-it rule. And again, you can include a grace period just like you did under health FSA. But unlike an FSA, a dependent care plan is not subject to the uniform coverage rule. You only reimburse up to what's in the employee's account. COBRA doesn't apply. The expenses are for employment-related expenses, allowing the individual to work. The expense must be for one or more qualified individuals, and care must be provided for the well-being and protection of the qualified individual. The problem is many employers are confused by this plan. They think dependent assistance, dependent care assistance means, okay, I'm reimbursing medical expenses for my child. That's not it. It's for the custodial care of a child. So some of the reimbursable expenses on DCAP is babysitter inside or outside the home, daycare for school children during vacation, daycare center that meets state and local regulations, elder care, and sick child facility. All could be reimbursed under this. Some of the expenses that cannot be under a DCAP, expenses due to unpaid or volunteer work, payments made to the employee's child under age 19, daycare that does not comply with state and local requirements, educational expenses for kindergarten or above, expenses for overnight camp, and incidental expense billed separately from dependent care expenses. So it's got to be for the care of the child. And again, just like a health FSA dependent care, there has to be claim substantiation. A written statement from an independent third party statement must indicate the amount of expenses, written certification by the participant that the expense has not been reimbursed by any other plan, and the name and address and tax ID number of the provider. So again, just like under health FSA dependent care, that claim must be substantiated. The annual limits, these are statutory, they don't go up. The maximum is the lesser of $5,000 if you're married filing jointly, or $2,500 if you're married and filing separately or single individual. If your income is less than that, and it's up to the income that that person makes. And again, these amounts are on a calendar year basis. You have to make sure you don't, if you have a dependent care plan that's not a calendar, you have to make sure that those limits are not exceeded. Employers are not responsible if the married couple violates this rule with double dipping. And again, you can, generally the elections under this plan are irrevocable. Mid-year elections may apply. Election changes, and those events, generally, if you change providers or if there's significant cost increase, you can change your election under a health FSA. All right, let's turn to health reimbursement arrangements. These were, again, provided in Revenue Ruling 2002-41 and Notice 2002-45. It's very similar to a health FSA. And it's a welfare plan under ERISA. The only difference is it is all employer contributions. It's considered to be an employer-sponsored self-funded plan subject to Code Section 105, financed by employer contributions. You reimburse expenses for medical, and again, because the fact that it's employer contributions, you don't have elections here. And what's important is you as an employer can pick and choose what expenses you want reimbursed. You can allow unused amounts to be carried over to the next plan year or forever. You reimburse participants for medical expenses. And it can be used with high deductible plans, because in that situation, if you have an insured group health plan, this is a self-insured, and you can pick and choose, do you want to reimburse deductibles, copays, coinsurance? And it's all your money. So the employer controls what medical expenses are reimbursed, controls the amount of the reimbursements per year. It can be used to provide retiree medical, and it can reimburse premiums or just expenses. And the employer will lose any amounts once they leave employment, but again, they can elect COBRA in this situation. There's a plan document, enrollment form, expense reimbursement form. If you have 100 or more participants, there's a form 5500. There's a summary of benefits and coverage, and if to file a 5500, there's a summary annual report. Does an employer have to be used with a group health plan? Yes, it does. It has to be integrated. That's what this slide is trying to say. So again, you can't do a freestanding health reimbursement arrangement. It's got to be integrated with the group health plan of your employer or with the employer of a spouse. That's what this basic slide is trying to say. So the plan has to be integrated. Who is eligible to make or receive contributions? The employer determines which employees are eligible to participate, but again, you have to meet the eligibility tests under the under Code Section 105H. So you can't just offer this. You can't just offer it to just certain employees. You just have to make sure you can pass the eligibility test. Self-employed individuals, partners, and more than 2% shareholders cannot participate. So must ERISA requirements be met? Yes, you have to have a plan document, claims procedures, reporting and disclosure, fiduciary requirements, and you also have to give a summary plan description. Can the employer participate in a health FSA in the same month? Yes, you can do so, but the problem is you have to designate which plan of the health FSA and the HRA will reimburse first. So again, if the expense can be covered by both, the plan must specify that the health FSA must be exhausted first, because the employers will lose the money. If it doesn't specify, the HRA will be exhausted first. So again, you're going to have some angry employees, but again, you have to specify. And again, do the health FSA rules apply to HRAs? No, because there's no employee contributions. It's all employer contributions. So the use it or lose it rule doesn't apply. The uniform coverage rule applies. You only reimburse up to the amount in their account. So again, this plan has a lot of advantages over the health FSA. What contributions are permitted and how they treat it for tax purposes. Again, you can reimburse premiums or expenses. You can reimburse for those expenses indicated in the plan document. What expenses can be reimbursed? The plan can reimburse medical expenses or premiums. And again, you can describe exactly what expenses, and the most common in this situation, the employer will generally reimburse those not paid by the deductibles, co-pays, and co-insurance. But again, the easiest way to administer a health reimbursement arrangement is design the plan to say, we're going to mirror our group health plan and just bring us an EOB and showing that you weren't reimbursed, and we'll reimburse you. We're not going to reimburse you anything else. Can HRAs reimburse premiums for individual coverage? No. Now, there is a qualified small employer HRA that's been around since 2017. I'll be talking about in the next few minutes. Can unused amounts be carried over to future year? Yes, but it's up to you whether you, as an employer, whether you're going to allow it or not. And the employer may specify the carryover amount and period. So you can do it, but you don't have to. So the amount allowed to be carried over will be considered as an expense on the employer's balance sheet, which is important to understand. It's a liability. Once contributions are made, can they be forfeited? Yes. You can specify to the employee that you have to use them within a certain period of time. You lose it. It's up to you how you want to do it. And the employee can continue to use the HRA if he or she elects COBRA. So it is subject to COBRA. And must the benefits be funded? No, it can be paid. What that means is it can be paid out of the general assets of the employer. The employer doesn't have to set aside funds for this. Are there any non-discrimination rules? Yes, there are non-discrimination rules. There's an eligibility test and a benefits test. And what I'm trying to say there is the fact that you cannot set up, because it's self-funded, you can't set up a plan just for the highly compensated. You have to include enough lower paid people in the eligibility test so you can pass these. That's what that is trying to say. So just remember, if you put in a self-insured plan, unlike an insured plan, there's going to be non-discrimination rules, and there's going to be an eligibility test and a benefits test. You have to make sure you run every year. That's what that slide is trying to say. When can the distributions be made? The employer decides in establishing the plan whether they're going to reimburse medical expenses, when they reimbursement will be made, whether any contributions will be available for reimbursements in future years. And again, just like a health FSA, the employer should substantiate medical expenses. So again, in this situation, the medical expense, you just have to make sure that those medical expenses have been incurred. Extremely important. What happens to the individual's HRA upon his or her death? His dependents can continue the plan under COBRA, so COBRA does apply. May the employer place any restrictions on withdrawals? Yes, an employer may put restrictions on what expenses can be reimbursed and the amount of the reimbursement. So again, because it's your money as an employer, you can specify limitations on when and how those monies will be reimbursed. And again, as I said before, does COBRA apply? And the answer is yes. HRAs are subject to COBRA requirements. Qualified beneficiaries will have access to unspent HRA money, and each qualified beneficiary will have an independent right under COBRA. So again, you have to decide what the COBRA premium is, and that's a discussion for another day in that sense. And again, I talk about how COBRA premiums are determined. Basically, it's based on prior experience of the plan. That's how the COBRA premium is made. What reporting is required? Here, 5500s are only required if it's funded or if you have 100 or more participants in your plan. You have to do it. Why would an employer participate in an HRA? Again, what disclosure is required? A separate SPD and a separate SPC. Employees must be offered an opportunity to permanently opt out as part of the requirements. Why would an employer participate in the HRA? Because it's your money as an employer, you have complete control how the money is reimbursed, what unused amounts are carried over, and for what period of time they carried over. And you as an employer can decide from year to year how much you're going to contribute. And again, if you have a current health FSA, it can work with a health FSA. Why would an employer not participate? Well, again, you have the ERISA requirements like you would on your normal group health plan. There are non-discrimination rules. Just like a health FSA, you have claims to substantiation. And again, what you're going to have is it doesn't have to be funded, but you have to have enough corporate assets in order to pay the benefits. And some actuaries tell me that may reduce the savings for going to a high deductible plan. And again, just like a health FSA, you do have COBRA. So very briefly, I just want to mention qualified small employer HRAs. These are brand new for 2017. Only those employers that are under 50 employees who don't 50 full-time employees who don't offer a group health plan can reimburse premiums and expenses. And they have to offer, the HRA has to be offered on the same terms for all full-time employees. If you do that, there's no non-discrimination rules. Employers may designate the plan to exclude the following employees: part-time or seasonal, employers with under 25 employees, union, and certain non-resident aliens. There are reimbursement limits. For 2017, it was $49.50 for single and $50.50 for 2008. It should be 2018. $10,000 in 2017 and $10,250 for a family coverage. Again, the limits are prorated if you have a short plan year, if somebody doesn't participate for all 12 months. Reimburse expenses is any 213D expenses, but just like a normal HRA, you have to show proof that you've actually incurred the expense. So again, this can be offered only for employers who are under 50 full-time employees and do not offer a group health plan. You have to give the employees a notice every year, 90 days before the beginning of the year, the fact of what you're contributing. That's what that slide says. And again, the HRA in this situation must be reported on the employee's W-2. This only applies to the qualified small employer HRA, and this HRA is not subject to COBRA. Okay, finally, let's turn to health savings accounts. Health savings accounts have been around since 2004. They're under code section 223. The best way to understand what HRA is, I call this a medical care IRA. It's held in a tax-exempt trust or custodial account. The only requirement to participate under a HSA, you're participating in a high deductible health plan. As long as you are participating in that, it can be an individual account or can be under a group health plan. So again, the money has to sit into an account. There can be employer and employee contributions, but you must participate in a high deductible plan. So again, eligible individuals are those who are covered only under a high deductible plan. Individuals enrolled in Medicare are not eligible to make contributions. And eligibility is determined on a month-by-month basis. An employee who is covered under a spouse's dependents health plan, a comprehensive medical individual plan, or a health FSA or an HRA, unless the coverage is limited purpose, cannot participate. What is permitted coverage or insurance? You can be in a workers' comp program, automobile insurance, insurance for specified disease or illness, insurance that pays a fixed amount per hospitalization. All these you can participate into and still be eligible to contribute to an HSA. Can first dollar preventive coverage be included in a high deductible plan? Yes, these are all the different programs that can be included, and still you're eligible to participate under Health FSA. Can a employee participate in a Health FSA or HRA and HSA in the same year? Yes, but for any expenses below the deductible, it must be what's called limited purpose, which is dental, vision, and preventive care, and then full medical expenses above that. So you have to be very careful in regard to what you're participating under. If you're in a general purpose Health FSA, you cannot participate in a HSA. Extremely important. And what is a high deductible plan? In that situation, for 2017, it was a annual deductible of $2,600 or $2,700 for single, and it's going to be for family coverage $2,600 or $2,700 for family coverage. That's for 2018. As you see there is a limit for the out-of-pocket amounts. That means deductibles, co-pays, co-insurance for single and family coverage cannot exceed those amounts that you see there. What contribution is permitted? You can have employee contributions, employer contributions, or it can be contributed by a family member. It doesn't matter. It can be post-tax or it can be pre-tax. Any employer contributions will be pre-tax. But if you're going to do pre-tax, any employee contributions have to be made through a cafeteria plan. So can salary reduction contributions be made? Yes, you have to amend your cafeteria plans to add a HSA benefit in that plan. But you can contribute pre-tax contributions to a HSA contribution, but it must be made through a cafeteria plan. So if you amend your cafeteria plan to include HSAs, these contributions are not subject to use it or lose it, uniform coverage rule, or the mandatory 12-month period coverage rule. You can change your HSA contribution at least once a month. What are the limits? For single coverage, it was $3,400 in 2017, $3,450 in 2018, and for family coverage, for family coverage, it's $2,750 in 2017 and $6,900 in 2018. So depending on what coverage you have will determine how much you can contribute to the plan. Now, in addition to that, there's also a catch-up provision. As long as you reach age 55, each individual who's covered under the plan can contribute an extra $1,000. So that's something that's very important. What happens if the limits are exceeded? What this tries to explain is if you contributed over the limits, and many people do that because they've put the full contributions in the beginning of the year and then their coverage changes. Just remember in this situation, if you have over contributed, you have until the due date of your tax return for the year. For this year, it would be April 15th of 2018 to take it out. If you don't do it, those excess contributions, as you see here, are subject to a 6% penalty. Extremely important. So again, what happens in most situations, people put the full amount, they put a family amount in there, then they change jobs and their new employer doesn't have a high deductible plan. They have to make sure that people realize they have to take that money out or they're subject to that 6% penalty. When contributions have to be made for a year, you have until the due date of your tax return, April 15th of 2000 of any year, to contribute for the year. So for 2017, you have until April 15th of 2018 to contribute for 17. Are there any non-discrimination rules? If you contribute outside of a cafeteria plan, the contributions have to be comparable, which means It can only vary through the coverage you have. You can do one amount for family coverage and one amount for single coverage. If you don't want to do that, if you want to do matching contributions, then again, what you do is you contribute the amount through a cafeteria plan. But again, the comparability rules limit how much the employer can contribute and how they can vary it. When can distributions are made? It's up to the employee. And what's interesting about HSAs is the fact as long as you have medical expenses, you can reimburse yourself at any time. So you could have an expense in 2016 or 17 and not reimburse yourself until years later. And what some people are doing is they're keeping their receipts, having medical expenses, and then using that money for other purposes. As long as you had medical expenses in the past, didn't reimburse yourself, you can use that money for any other purpose. That's the beauty of this. So you can reimburse yourself 5 or 10 or 15 or 20 years in the future for medical expenses that you've kept and not reimburse yourself. So please, that's extremely important. Now, distributions from an HSA that are not for qualified medical expenses are included in your income. And these taxable distributions are also subject to an additional 10% tax. Now it's 20%. It's now 20%. And that goes away when you reach age 65. Who substantiates if you're paid for medical expenses? That's between the participant and the IRS. You claim it on your 1040 on the form 8889. And again, any trustee or custodian is not permitted to substantiate, so it's the participants. And the major difference between an HSA and any other account is the account holder, the individual employee that actually administers the plan. They determine what they're eligible, they determine the contributions they're eligible for, and they are determine if whether that distribution is taxable or not. It's between them and the IRS. What happens to the individual's HSA upon their death? If they name their spouse, then the spouse just takes it over and just continues on. If they name a beneficiary other than the spouse, then again, it has to be distributed within a year of their death. So it has to go away. So if a spouse is named, then it just continues. But if any individual other than the spouse is named, then it's got to be closed out and the money is distributed and taxable. Amanda, do we have any questions?
All right, thank you everybody so much for joining us. We do have one. I understand owners cannot participate in FSAs, but are owners excluded from cafeteria plans in their entirety, like pre-tax medical contributions?
Correct.
For example.
Correct. Because they get a deduction off their tax returns. That's why.
Gotcha.
So above the line, they get a deduction. Now, I covered a lot of stuff in this seminar, but these three plans are extremely popular for employers right now, and there's so many nooks and crannies in these rules. You have to make sure you understand the complexities of a health FSA, a cafeteria plan, an HRA, and an HSA, because employees ask a ton of questions in regard to that. So please understand the fact that these are extremely complicated. Anytime the government gives a tax exclusion, it comes with strings. And all these accounts come with strings. Okay?
All right. That's all for right now. Thank you all so much for joining us. Again, our next webinar will be on January 16th, and we'll be covering wellness plan compliance. You can sign up right now at benefitexpress.info, and we hope to see you there.
Take care. Bye-bye.